Welcome to my channel. I'm Scott, and if you want to catch my newest video, I post one every day. In this video, I'm going to walk you through the process of valuing General Mills stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. General Mills is a marketer of consumer foods sold through retail stores. Its headquarters are in Minneapolis. The company markets many well-known North American brands, including Gold Medal Flour, Annie's Homegrown, Betty Crocker, Colombo, Totino's, Pillsbury, Old El Paso, Haagen-Dazs, Cheerios, Trix, Cocoa Puffs, and Lucky Charms. Let's get started with the model. This is a large cap company, 34 billion market cap. They're trading at $56 a share, and they have 611 million shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So you can see the company has lots of free cash flow, 2.2 billion up to 3.1 billion. Net income is the profit and loss on the income statement. It's revenue minus expenses. And they have pretty consistent net income from 2.1 billion to 2.4 billion. Revenue is the sales for the company, and that's also increasing at a pretty good rate from 15.7 billion to 18.3 billion. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. And the difference between those two numbers is their gross profit. And that seems to be increasing each year up to 6.5 billion. Below that is operating expenses. Gross profit minus operating expenses gives you your operating income. And that was also highest in the trailing 12 months at 3.3 billion. The company had $440 million of interest on their debt. Then there's other income and expenses. Then below that is pre-tax income. The company pays taxes based off of its pre-tax income. Then below that is earnings from equity interest. Earnings from equity interest is a non-cash item. If this company has a significant amount of another company's stock, then those earnings will go into this category. The bottom line of their income statement is their net income. That's 2.4 billion. You can see they had their lowest net income in 2019 at 1.8 billion because they had 217 million in other income and expenses. When you look at a company's income statement, you should focus on operating income because the stuff below that is outside of their operational business. So things like other income and expenses may skew the company's net income. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. Then you have capital expenditures, which are investments in property, plant, and equipment. And that's about $400 to $600 million a year. Operating cash flow minus CapEx gives you your free cash flow. This is the cash that's remaining to invest back into the business, to buy back stock, to pay down debt, or to pay a dividend. The company does have a good amount of free cash flow each year. In 2018, they issued $6.5 billion of debt. So the company has lots of free cash flow, so they're probably issuing the debt to acquire another business. After 2018, it looks like they issued a similar amount of debt as they paid down. The most important part of any business is their operating cash flow, and this company has lots of operating cash flow. And the way you calculate it, you start with net income that was 2.4 billion, and then you have to add or subtract the non-cash items on the income statement. They had a $580 million depreciation expense, so we have to add that back. They passed through a gain of $188 million, so we have to subtract that out on the statement of cash flows. So even though they reported $2.4 billion of profit, they actually generated $3.6 billion of cash flow because net income is accounting profit and loss. It's not actual cash. Let's look at a capital structure. $15 billion of equity, $14 billion of debt. So they're 52% equity, 48% debt, and their WACC is 6.2%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimate a terminal value, which is all cash flows past year 4, that's $63 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $57 billion. We divide that by 611 million shares. And we get a calculated stock price of $93. They're trading at $56, so they're trading at a 40% discount. It's a strong buy according to the model. Simply Wall Street is even higher than me. They're at $99 a share, so they're also saying the stock is really undervalued. The stock was higher in 2016, almost $70 a share, but it's come down quite a bit, and then it's come right back up. The company pays a 3.6% dividend yield, and they pay out 51% of their net income and 39% of their free cash flow. They have a really low beta, 0.55, so the stock moves about half the market. The stock has gone up 3.5% in the past 52 weeks, much worse than the S&P 500. The low was 47, the high was 66. And the stock is trading below its 50-day and 200-day moving average, so it seems to be on a downtrend. About 4 to 8 million shares are traded each day, and most of the shares outstanding are on float. About 77% of the shares are held by institutions, and 3.3% of the shares on float are shorted. If you invested $10,000 into this company 10 years ago and reinvested the dividends, you'd have $22,000 today. If you did not reinvest the dividends, you'd have $20,400 today. Capital Research is the biggest shareholder at 9%, then Vanguard, then BlackRock, State Street, and Vesco. Let's look at the financial ratios. The average PE in the market's 10.8, the median is 14.3. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They're at 14.1, so investors are paying $14 for $1 of earnings. Price of sales is stock price over sales per share. They're at 1.9, better than the median average. Price to book is stock price over book value per share. They're 2.3, also better than the median and average. And the way you calculate book value per share, it's equity over shares outstanding. Equity is assets minus liabilities on the balance sheet, and they have $15 billion of equity, negative $13 billion of tangible equity, since they have $21 billion of intangible assets on their balance sheet, $14 billion of goodwill, and $7 billion of other. Interest coverage ratio is EBIT over interest expense. They can easily cover their interest payments. ROE is net income over equity. They have a pretty good ROE at 16%. Current ratio is current assets over current liabilities. They can cover 70% of their current liabilities with their current assets. And their current assets are $1.7 billion of cash, $1.8 billion of receivables, and $1.4 billion of inventory. So it does look like the company will need to take on more debt to run their business over the next 12 months. Because they did have $3.1 billion of free cash flow, but they have negative $2.4 billion of working capital, and they have a $1.2 billion dividend payment. The best way to look at ratios to compare them to similar companies, I've done videos on Beyond Meat, Conagra, Hormel Foods, Kellogg, Kraft, and Simply Good, all in the same industry as General Mills. And if General Mills has a number in green, they're better than the average. If they have a number in red, they're worse than the average. They have a better PE than average because the average is negative. They're much better in price to sales and price to book. They have a terrible current ratio, one of the worst in the industry. They are a little better in ROE, a little worse in debt. They're a big company, $34 billion market cap, and they pay a higher dividend than average. So to summarize, I have them trading at a 40% discount. This is a big company. It's been around a while, and their products are really well known. They do have really strong revenue and free cash flow, and their ratios look really good as well. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.